You have to invest as if you're already on the other side of the table, because the moment the money from your bank account hits their bank account, you're on their side of the table, and you look around, you're like, look at this shiny new company that I am now part of. Oh shit, there's an idiot investor on the cap table that owns 40%, a non-operational shareholder who owns 40%. I just bought a piece of shit. And it's a piece of shit because you made it that way. The moment your money hits the bank account, it's your piece of shit. So stop breaking it on the way in.
You're listening to the Startup Podcast. This is an educational episode, in-depth masterclasses about the concepts essential to building, running, and investing in Silicon Valley-style startups. Whether you're a founder, investor, or operator in a startup, you'll gain insights into the principles that power high-growth disruption, the same way Facebook, Google, and Uber do it. The conversation starts now.
Hi, I'm Yaniv Bernstein.
And I'm Chris Saad.
And in today's episode, we're going to discuss 6 bad investor archetypes. We've all come across investors who make us scratch our head, who make us scream out in frustration. We previously had an episode on 7 bad founder archetypes, so we thought it was time for investors to get their turn. You will not want to miss this one. We have the Predator, we have the Buzzword Butterfly, the Midwit, and more. So stay tuned and find out about the 6 bad investor archetypes right after the break. Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for SOC 2, ISO 27001, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. And it gets even better. Just for TSP listeners, you can get $1,000 off Vanta when you go to vanta.com/TSP. That's VANTA.com/TSP for the Startup Podcast to get $1,000 off.
All right, Yaniv, we're about to talk about these archetypes, but before we do, we've got to talk about the Startup Podcast Pact and the Startup Podcast newsletter. If you've been listening to the show for a few weeks and been getting lots of value out of it, we ask for only one thing in return, that you help us grow the show. Give us a shout out on your favorite social network, subscribe to us on your favorite podcasts and on YouTube, and tell your friends about how awesome the show is. It helps us grow the show, helps us get more guests, and helps us keep doing what we're doing. Also, don't forget to subscribe to the newsletter over at tsp.show. It helps you get direct access to our content, posts from Yaniv and I, some behind the scenes clips and bits and pieces, and a whole lot more. So go subscribe over at tsp.show. With that, let's get into it.
So Chris, I actually wanted to give a shout out to one of our listeners, Rowan Junio, who suggested this episode and actually even suggested some of the archetypes that made it into this show. So it's so fantastic. We're getting great episode suggestions from a listener. Rowan, I hope I'm pronouncing your name correctly. Thanks so much for the suggestion. Let's get into the 6 bad investor archetypes. The first of the 6 bad VC archetypes I wanted to talk about, Chris, is what I call the midwit. Now, the midwit is someone who thinks that they know how business works, and therefore that they know what the right questions are to ask a startup. And they're all about business stuff. And when I say that, they're about, revenue. How much revenue are you making? What are your metrics? Show me your model. What's your 5-year projection? Your risk register, all this stuff, right? So taking a lot of the ideas that might apply in a traditional business or in a more mature business and trying to apply those to a startup. And the reason that doesn't work is because at that point, your startup is not a business. Your startup is an idea and a whole lot of energy on trying to discover how to make that idea work in the real world. And so no amount of modeling, no amount of revenue questions and assumptions are going to answer that for you. And all they do is distract you from the true path.
Which is solving a problem, creating a product that anybody cares about, and any early signs of product market fit that you've created real value, right? And so, yeah, in the very early stages, we're talking about angel, pre-seed, seed, and, they're confidently asking you for, revenue as if that's a major part of the business, or your revenue projections, or trying to understand every nook and cranny of your, unit economics. They're very confident about this, right? And they're making it, they furrowed brow, and they're talking to you like serious businessmen and women. And really what they should be talking about is like, where is the real pain in the market? Where is the real pressure points? Where are the real entry points? How do you go from the thin wedge in the world? How might you start to crack that wedge open? What does the product actually do? What are the signs of life that people are finding delight, joy, or relief of suffering from this product? These are the questions that matter. And also, who is your team, and why does that team got, founder problem fit? What evidence do you have that you understand some of the, hustle and some of the needs to be agile and learn and iterate and pivot? Any questions that make this about like, what is your business? It's just like, I'm pre-seed. Can you give me a break here? We need to talk about some of the stuff that really matters.
Again, I think this is one that we're sort of misunderstood about quite a lot, Chris. And, I think we're getting a little bit notorious for saying, don't focus on revenue. And sometimes that makes people upset on the internet. So I think it is worth going into this a little bit more and what we mean by it and why it's so important, right? I think revenue is fantastic if it is aligned with what you're trying to build. It is one of the best signs of product market fit if you have people willing to pay for what you're building. But what you are doing there with the revenue or with any of these other things that are more businessy, by having excellent unit economics and so on, you are proving that you have something that you can potentially scale, right? So if you've got revenue that you're like, hey, we've built the same thing and 10 people are paying for it and the retention is incredible and they're happy to keep paying for it. Well, that's interesting to me because that's a sign of strong traction. Then I'm like, okay, go find more of those people and then we're really cooking. If you've built a bunch of different things for a bunch of different people, if you've got a mix of services revenue and like non-recurring revenue and so on, and sure, it's gone up by 100% in the last 6 months, but it's still negligible. Well, that's low quality revenue. It is not a signal of traction. It's a signal that you've just been hustling for some cash and that's great, but it does not do anything to give me confidence that you've actually got a product and an approach that's going to get traction. So this is really about saying, how do I work backwards from the big thing that we're all saying we're trying to build? And are we de-risking this? Are we actually getting some strong signs that this is the right team, the right approach, that there are these early signs of life, as you say, Chris? And whether that's revenue or really cheap cost of acquisition, really strong retention, it can be any number of things, but you need to interpret them in that context and not just put them into a spreadsheet and apply a bunch of traditional business model thinking to understand what's going to happen. And the Midwit VC or the Midwit investor, there's two types of harm that they cause, right? First of all, is simply the fact that they're going to be investing in the wrong sorts of businesses. And so they're going to be passing on really good businesses. That's more their problem than your problem, right? Because this is sort of the dumb money that we talk about, Chris. But the more pernicious thing is they can be really convincing. They're like, I've done this a million times before. I know how to build a business. This is how you do it. And they can take founders who are actually doing the right things and convince them to do the wrong things. And that's even if they don't invest, simply by being so forceful in the wrong direction. I think that can really be dangerous.
That is absolutely the biggest problem. It's not the companies they invest in. It's the companies they don't invest in that they derail by the nature of their questions. So this is a big part of why we rail against this on the show nonstop, because of all of these precious founders with their precious ideas and amazing energy that are being thrown off in the wrong directions, and it frustrates the heck out of us. So watch out for the Midwit VC archetype. Ask them what their portfolio investments are and which have been successful. And maybe more interestingly, ask them which ones they've passed on that have been really successful. In Silicon Valley, I don't know if they do this as much anymore, but I remember there were a lot of VCs that used to put up their failure wall. All the startups they skipped, they passed on that were huge successes, to kind of illustrate that, they're no smarter than founders and that they're in it with founders as well. Some of the top funds did this. It just shows, A, VCs don't really know what they're talking about. They're just like you, stumbling around in the dark, trying to figure out what might work. And B, a lot of VCs have never made a good bet in their life. So they're worse than don't know what they're talking about. They're sending you off in the wrong direction. So pay careful attention to the midwits, to avoid them at least.
The next bad investor archetype is what I'm calling the predator, Chris. Now, the predator is someone who uses dirty tricks and effectively takes advantage of naive or desperate founders to secure an investment at terms that are very favorable to them, at least on the surface, and very unfavorable to those founders. There's some overlap with the midwit. The predator often sees that what they want to do is get a bargain, right? They want to get the biggest chunk of equity for the lowest possible price with all sorts of crazy things. Like they might even charge the founder fees for advice and goodness knows what, because they are basically seeing it as this sort of fairly simple zero-sum transaction, right? Where more for them means more for them. And ultimately, a bigger slice of the pie means they will get a bigger exit. And this one's really heartbreaking because it doesn't work that way. And again, Chris, we've talked about this on previous episodes of the podcast. A good relationship between early investors and founders is this delicate type of partnership where the shape of the cap table actually needs to be balanced. And this is not for some moral reason, but to keep incentives aligned. If founders lose too much control of their company, they're not going to build it into that amazing return that they have the potential to do, right? They will lose motivation, and even more so, they will fail to be able to attract interest from better investors in subsequent rounds, because those investors will look at the cap table that has been torn apart by the predator and they will run 100 miles in the other direction.
Yeah, you have to be a midwit investor to also be a predator investor, right? So it's like predators are subsets of midwits. So, but the case here is not only do they give bad advice and look for the wrong things and invest in the wrong companies, once they are lucky enough to get a deal worth doing, they're investing in the wrong way. Because as you said, they're transactional. They think the more they can take, the better it is for them. You touched on all of it already. We've talked about it many times on the show before, but just to put a very, very fine point on it, if you are a midwit investor and you are a predator, also a predator, and you're trying to take, 40% of the cap table, there's no chance that smart money will come in after you and invest in that company. And therefore, you're holding the bag on a shit sandwich because you're going to run out of capital and you will not get follow-on capital. No investor is going to invest in a company where you took 40%. It's not going to happen. Or you're going to get more dumb money on the cap table, and all you're going to be is a kind of a dumb money party of people looking around who don't know how to execute, operate, and invest and exit. You're breaking the cap table. You're breaking the incentives for the founder, because the founder, after a couple of rounds, is going to be diluted to hell and going to be demotivated. Chances are that thing basically gets flown into the ground. The way I often put this is, you have to invest as if you're already on the other side of the table. Because the moment the money from your bank account hits their bank account, you're on their side of the table. And you look around, you're like, look at this shiny new company that I am now part of. Oh shit, there's an idiot investor on the cap table that owns 40%. A non-operational shareholder who owns 40%. I just bought a piece of shit. And it's a piece of shit because you made it that way. So just remember, the moment your money hits the bank account, it's your piece of shit. So stop breaking it on the way in.
To those who are listening to this and thinking to themselves, that's not really how the world works, let me tell you it is. I advised a wonderful startup run by two incredible founders. The two founders, between them, had less than 20% of the company. And this is at the seed stage, because they'd actually spun out of another company. The investors took 80%. And guess what? They found it impossible to raise. They needed more capital, and every real VC looked at them and said, we can't invest in this. And so, the small role I played was in sort of helping these founders, I guess, make it clear that the cap table needed to be reconstituted so that this thing was actually investable. And that meant basically getting more equity than they had. Not for selfish reasons, or not only for selfish reasons, of course they wanted more equity, but because the company as it was literally uninvestable and was simply going to die. They seriously considered quitting their own startup that they had founded because the cap table was so screwed that they simply couldn't see a way forward. So predators, they're really killing the goose that lays the golden egg, and it's just a real tragedy when it happens.
I will tell one story, actually, which shines a really positive light on an investor I know, Danny Gilligan from Reinventure, where he bumped into a startup that was misorganized. Cap table was a disaster, and earlier investors had taken too much. And to his credit, he really liked the company, really liked the founder. He actually worked with them to reorganize the cap table and basically right-size the founder's piece so that he could then invest at the appropriate amount and dilute the founder the appropriate amount. Most investors will not take the time to do that. They will basically discount the founder. They'll discount the other investors. They don't want to be on a cap table with those investors. And they will just go, no, thank you. You guys obviously don't know what the hell you're talking about. And so, yep, watch out for the predator. Bad news.
Archetype number 3, bad investor archetype number 3, is what I call the term sheet tease. You could say this is a subtype of the predator, who Chrissy said is largely a subtype of the midwit. So yes, this is not like a clear division. This is a messy Venn diagram.
This is not a MECE list, right? Mutually exclusive, collectively exhaustive.
That's right. I have
Yes.
never worked in management consulting. You can stick your MECE where the sun don't shine. This is my podcast, and we are talking about the term sheet tease. The reason I separate this out is both because it's common and because it's something that sometimes investors who know better should do. So, we've talked about predators as always being midwits. The ones who are trying to take huge amounts of equity and so on are really screwing themselves. But the term sheet tease is playing a slightly more sophisticated game, and it's a game of leverage. And so sometimes they can actually be smarter, but just a bit evil, right? Now, what the term sheet tease does is recognize that the longer it takes to close a deal, generally, the more leverage they as an investor have relative to the founder. Why is that? Why does a company raise capital? Because they need it, right? Sometimes they need it because they see a great market opportunity that they'd like to grow into. More often, they need it because they're burning cash. So they have a runway, and that runway is getting shorter and shorter and shorter. And the shorter your runway is, the more desperate you become. And the more desperate you become, the more you have to take whatever it is that you are offered. And so what the term sheet tease does is act really interested, slow play things though. It might just be a little bit longer. They say, we just need our lawyers to draft this up. Eventually, they'll even get a term sheet out to you, right? Now, what a lot of founders don't realize is that a term sheet is non-binding, right? A term sheet is not a contract. It is not a shareholders agreement. It is a document that lays out an offer that, if accepted, then kicks off the actual formal process of closing that round and getting that investment. And so between a term sheet being issued and signed, and then the actual shareholders agreement being created, if you're doing a priced round, a lot of time can pass. And for the VC, it's no big deal for all that time to pass. For the founder, it can become an incredibly big deal because you're watching the money in your bank account dwindle towards zero. Another pernicious thing about this is sometimes you've got investors who are purely evil who are doing this deliberately to gain leverage. Sometimes they're just being a little bit slack and lazy and not empathizing for the founder, but the result is the same, right? Which is that the startup is harmed, the founder gets unnecessary stress. Often they have to cut back on spending unnecessarily because they're not sure that their capital will last until the money is in the bank. But yeah, the ones who are doing it on purpose are doing it to extract leverage, to get perhaps a lower valuation, to get perhaps more controlling clauses, another board seat or something like that. So there are actually things that an investor might want, which will not necessarily poison the cap table, but that a founder may not want to have. And so this game is really nasty, and it's something you want to watch out for and just realize how much time can pass between getting a term sheet and the money landing in the bank, and think about what happens to your leverage as that clock ticks down.
So the term sheet tease, best case scenario, they lack empathy for founders. Worst case scenario, they're using it as a tactic to be predators, which is the second archetype, right? Which means they're midwits, which is the first archetype. So, they're trying to get more leverage so they can get a better deal, which, as we discussed in the predator section, is often bad for them in the first place. So the best VCs in the world understand that the best companies in the world have competitive offers. There are people actually competing to get in the deal. So if you're slow walking, you may actually miss the opportunity. The best funds in the world understand that founders are the lifeblood of their company, of their firm. And they understand that they need to treat founders incredibly well. They are the goose that lays the golden egg, to use your term, Yaniv. That means you organize and operationalize your firm so that you can do diligence quickly, make a decision quickly, issue term sheets quickly, and close down and paper the rounds as quickly as you can and get the capital over to the founder as quickly as you can. Anything short of that is value destructive. You are destroying, you're eroding the value of the thing you're trying to buy. So it's like trying to buy a home and you're walking around the home, pissing in the corner and, scraping off the walls and going, they're going to give me a better deal on this home. But you're pissing in your bedroom that you are about to buy. Right? So just like, what are you doing? What are you doing? It's an asset, guys. It's an asset. You want to protect the asset and you want to protect the caretaker of that asset, which is the founder. Keep in mind what you're doing. One of our favorite sayings in this podcast is know the game you're playing. This is VCs not knowing the game they're playing. They're not knowing the asset they're buying and what will make that asset valuable.
Yeah, look, I largely agree with you, Chris. I think there is a gray zone, right? Like, I think we've talked about the predators who are like purely shooting themselves in the foot, but their foot is on the founder's head. So, everyone gets hurt. But I do think, I can't remember what book it was from, but, one of those classic books on venture capital. And they say that, every part of a negotiation with an investor is about one of two things. It's about ownership or it's about control, right? If you poison the cap table, you get screwed. But there are also legitimate areas of negotiation, which does become a traditional negotiation about leverage. So, for example, consider something like liquidation preferences, which actually is not a problem for future investors because they get higher priority on the pref stack anyway. But the founders might not want liquidation preferences, especially, the sort of 2x, 3x ones that come in. But that's the sort of thing that an investor might push on them when the founder is getting desperate. And so I do think there can be investors who are both predatory at the margin, but also quite smart, non-midwit investors. So like I said, there's Venn diagrams, there's a lot of overlap within these things, but I do think it's not always the case that an investor acting in a predatory way is harming themselves. They might only be harming the founder, and that's simply unethical rather than stupid.
Hang on, you mean not in a predatory way, but a term sheet tease way, or both?
Well, term sheet tease is a type of being predatory, right? But I think having negotiating leverage, there is a legitimate negotiation that happens, right? It's not simply the case, I don't want listeners to come away from this with the impression that there's this sort of kumbaya that like the interests of the investor and the founder are so perfectly aligned that the correct valuation, the correct control clauses, liquidation preferences, board seats are magically agreed on. There is a window, there's a space of what's reasonable, and some is more founder friendly and some is more investor friendly. You're negotiating over where in that window things sit. And if the investor has more leverage, it's going to be more on the investor side. And so that's what I'm saying. It's not necessarily a midwit thing to do. Over 7,000 global companies like Atlassian, Dovetail, FlowHealth, and Quora all use Vanta to manage risk and prove security in real time. Why aren't you? Get $1,000 off Vanta when you go to vanta.com/TSP. That's VANTA.com/TSP for the Startup Podcast to get $1,000 off. The next one, this is maybe a bit of a short one, but it's common enough that I thought we would cover it. And this is the VC or the investor who we just call the ghost. And this is like a real nuisance. VCs who are ghosts will basically do a whole lot of tire kicking. They will talk to you. They will act interested. You'll have a lot of interesting conversations with them. You might even think that you're getting close to a term sheet sometimes. And then one day, they just stop answering your emails. They ghost you. And that can be anywhere from a mild nuisance to something that nearly feels like a term sheet tease that can actually materially damage your raise because you thought that you had someone who was genuinely interested who just disappears. Why investors do this, I think there's a range of reasons, from somewhat covert data gathering for a competitive landscape to being disorganized. Big firms sometimes have associates who do all this stuff and then the thing just gets lost in the wash, to, I guess, just being lazy and rude and basically deciding to pass on you, but without actually telling you that. But the ghost is very common and it's just something that you have to deal with, I guess. And, I think the lesson with the ghost is do not count on anything until the money's in the bank, or at the very least until you've got a signed shareholders agreement. Because one thing that VCs can do quite well is act very interested without in fact being interested at all. And the first time you find out their lack of interest is when they ghost you.
As you said, this might be because they're conflict averse. They just don't want to have the hard conversation. It could be because they're gathering data. It happens, and it's not something that can be stopped or something that's necessarily out of the realm of legitimate or reasonable. VCs get a lot of pitches. A lot of these pitches are about the same idea or the same category of idea. And they're trying to figure out, what does this landscape look like? Who has the best ideas? Who's got the best founder problem fit? Who's the best team? Who's the one that's really going after this, that's most credible? And this is why VCs and other vendors in the space won't sign NDAs, because your idea is not original and unique. The question is who's executing it best and who's in a position to win. Oftentimes, it's not that they're cross-pollinating the information. That's not what they're necessarily doing. What they're doing is they're using the information across multiple companies to figure out which one has it right. They might, allude to something here. They might add a quiver to their bow when they're talking about the problem next with the founder they end up betting on. But it's about triangulating the right company, and they may then go bet on someone else that does the exact same thing you were pitching them, and then you can accuse them of having stolen your idea. They didn't steal your idea. They just bet on someone else with the similar idea. That just happens a lot because there are these ideas whose time has come, and all of a sudden there are 7 rideshare companies in the world, and they're all jockeying to be the ones that are venture backed by the best venture firms. Sometimes you're an Uber and sometimes you're an also-ran. It's a brutal business.
Yeah.
It's a brutal
Yeah.
ecosystem. And it's also a small ecosystem. It's just going to happen. You got to watch out for it.
And just one thing I would add, Chris, if you send your deck cold to an investor and they never reply to you, that is not being ghosted. When you send somebody a cold email, this is not just investors, this is anybody. They don't owe you a response. You are helping yourself to their inbox. They might see a thing, they might not. They might respond, they might not. That is not ghosting. That's part of the game. Like you said, there are a lot of pitches that come in, and a lot of them are simply not interesting. I think it's good manners to decline, but I don't think it's terrible manners not to.
Yeah. Ghosting is, like dating. It's when you're chatting to someone and they disappear. If you just message someone and they don't reply, they're just not interested.
Sadly, you just have to be thick-skinned as a founder. There's going to be a lot of rejection. Ghosting is not just rejection. Ghosting is a type of like gaslighting where you just have no idea what just happened. Let's go to number 5 of our 6 bad investor archetypes. Now, this one I call the big hat, Chris. So I don't know if you've heard of that phrase, all hat and no cattle. Comes from the Wild West, where you have people walking around with a giant cowboy hat and not many cows, right? So this idea that they're projecting, their power and their wealth, but they don't actually have anything behind it. And so the big hat investor is someone who is acting like they're looking to invest in your company, only they don't actually have the money to do so. Let's talk about why that might happen, because that sounds like bizarre behavior, right? So there might be a few different reasons.
Look, in the startup ecosystem, and especially in Silicon Valley, there are a lot of these archetypes or these roles that people play. There's the founder, there's the VC, there's the angel, there's the journalist, there's the, influencer, you name it, right? And they each have these signaling techniques that they can do, and they each have a different kind of place in the hierarchy and a different level of influence and what have you. And so it's really, really cool to be a VC. It's really cool to be an angel investor. It's really cool to walk into a room and say, I have capital to deploy. You instantly have a higher room rating, right? But that doesn't mean that you actually have capital to deploy. You could literally be just playing a game. You could be just saying that you have capital to deploy. Your fund could be closed. You still could be raising money from LPs. You could be not interested in that category, or that your thesis is not even about the thing that the event you're attending. All sorts of reasons why you are not actually deploying capital anywhere in the vicinity of this founder. But, you're going to play that category, right? I'm a VC, I'm an angel, and you're going to get that room rating. When I say you, I mean the big hat persona here. And yeah, you're just not legit. And this happens a lot in all categories. There are people who run around the ecosystem in Silicon Valley who claim to be founders, but they're not founders. They have no startup. They have no co-founder. They have no momentum towards deploying or delivering anything. They have no traction. It's like a side project, and they're tinkering with, or not even. They just have an idea that they pretend that they're working on. This happens in every category. And it's a bizarre thing of innovation theater that occurs within the center, the ecosystem, the epicenter of innovation culture. You can bet that it happens in second and third tier markets where there are even fewer people with capital to deploy and even fewer founders with real companies doing real things.
The last of our 6 bad investor archetypes is what I call the Buzzword Butterfly. And the Buzzword Butterfly is also, I guess, a type of midwit, but they're the opposite type of midwit. They believe too much in whatever is peaking on the hype cycle. The Buzzword Butterfly was that investor who used to be all in on crypto, and then they woke up one morning and they were all in on AI. Again, not that there's anything wrong with being heavily into crypto or heavily into AI or having an investment thesis, but that's exactly the point. These folks do not have any sort of concrete investment thesis beyond this thing is what everybody is talking about right now, and so I'm going to invest in it. These folks, they don't really understand the difference between what will make a startup successful or unsuccessful. And in the same way that I criticize the midwit for being too focused on business metrics and whatnot, I think this type of person, the Buzzword Butterfly, is really just looking for you to check off a bunch of buzzwords on their bingo sheet, right? Where you're like, okay, are you your Web3, crypto, AI, cloud, whatever it is? And they're not thinking, are they building a product that customers will love? Are they the right team to be doing it? Do they have a proper distribution strategy? Do they have any traction? No. They're just looking for the buzzwords. And these folks, I think the main harm they cause is to their investors, to their LPs, honestly. But they also have a secondary negative effect of distorting the market, because then they basically create skewed incentives for founders to be buzzword compliant. For example, how are you wedging AI into your app rather than focusing on actually solving the problem, solving that pain point, and then creating something scalable out of that is really generating value for people.
Yaniv, the thing that all of these have in common is that you have to recognize something. That VCs, while they appear to be kind of higher up in the hierarchy than founders, they appear to be these kind of kingmakers, these very important nodes in the network. They have a lot of advantages over founders. They have lots of data points. They get to meet with a lot of founders. They get to see a lot of companies. They get to pattern match. They're multi-move players, so they get to invest in multiple companies instead of just one company. They have access to what is, perceived to be and is often a scarce resource, money. And so, there's a lot of reasons to admire and to be concerned about the concerns of VCs. But the reality is these guys are basically business owners, just like you. They've started a firm or they're employees at a firm. They themselves are raising capital from LPs. They're hustling and struggling and pitching just the same way you are. And they're typically not that much cleverer than the better founder. They're just trying to figure out the future and figure out the world just like you. This means that there are really dumb VCs, there are really average VCs, and then there are very, very good VCs, the same way there are dumb founders, average founders, and great founders. And so, this is another way, amongst the other 5 ways that we've listed, that VCs can really reveal their midwitness and really be doing a bad job at their business, which is, spotting talent, spotting companies, and betting on winners. The other thing I'll say about Buzzword Butterfly is a lot of VCs, actually, even the smart money, are pretty sheep-like. They tend to follow the crowd and the trends. Part of that is the limits of their understanding. They're not brilliant, they're not clever, as I just described. They're not domain experts. But part of it is also rational and clever in the sense that they know everybody else is doing that. And so if you're investing at seed, you need to be able to get your company to Series A. And they know that all the Series A investors are following the trends and are, in this case, at this moment, looking for AI startups as well. And so they're not going to go invest in some crypto company or in some two-sided marketplace or some social media thing when everybody in the ecosystem is investing in AI. Partly it's lazy, partly it's they don't know any better, and partly it's rational because they need to get you to the next round. And the next round is likely from an investor who is also playing this buzzword game.
It's all fair, right? I think really the aim of this episode, Chris, is firstly to have a bit of fun, right? But secondly, to allow founders to recognize the different types of investor they might come across. By the way, there are a lot of great investors, but there are these archetypes of investors who harm their firms and often harm founders as well. You want to be alive to these different archetypes so that you can avoid them or at least manage them appropriately so that you're not blindsided or surprised by that. But of course, everything you say is correct. One of my favorite laws is called Sturgeon's Law, and it basically goes 90% of everything is crap. So no matter what category you're in, founders, startups, investors, fruit, I don't know, look around you. 90% of it is crap. There's only 10% of it that's any good. And so this is not a criticism of VC as a sector any more than it's a criticism of anything else. But be aware that when you're raising capital, to your point, Chris, you don't want to revere your investors. You have to realize there are some very, very good investors. There are some mediocre investors. There are a whole lot of bad investors. And you need to be able to recognize the signs because getting good investors is a huge advantage to you in building the startup the way you want it and to reach the sort of outcomes that you are hoping to achieve.
And one way to figure out if they're a great investor is to look out if they're doing any of these obviously bad archetypal things. Mm-hmm. Also is to reference check them. Go talk to their startup portfolio, to their founders, reach out to them directly or ask for an introduction. And if they're hesitant to do that or making excuses, that's also another yellow flag for you to consider. All right, another fun conversation as always. Yaniv, how can people find you on the internet?
I'm mostly on LinkedIn, trying to make it a bit less of a boring place. I'm currently on an extended sabbatical, and yet somehow I can't stay away from LinkedIn. It's some sort of weird addiction, and I need help. So I'm still there. I love connection requests from TSP listeners. So if you connect with me, let me know you're from TSP. I'll accept the request, and I'd be delighted to have you in my network. All right, Chris, how about you?
You can find me on all the social media. If you want to see more of my life out here in Silicon Valley, you can follow me on Instagram. If you want to get my thoughts about startups, you can follow me on LinkedIn, or you can mainline my stuff over at chrissaad.com/newsletter. Catch you in the next one.
Today's episode of the Startup Podcast was brought to you by Vanta. Vanta automates compliance for SOC 2, ISO 27001, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies already use Vanta. Why don't you? Get $1,000 off Vanta when you go to vanta.com/TSP. That's VANTA.com/TSP for the Startup Podcast to get $1,000 off.